half of their portfolio into value, half of their portfolio into growth. So it's like a 50-50 split. So if you imagine a barbell with two weights on either side, you want that to be relatively balanced. The reason for that is you'll have different types of stocks do well in different type of market conditions. So obviously the past decade and almost 2 decades, we've seen huge appreciation in a lot of growth stocks. Just take any of your FANG stocks, Apple, Amazon, you could throw Microsoft in there too.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, I have a special guest back on the line, Andrew Sather from eInvestingforbeginners.com. Andrew's been on the show once before, and I enjoyed chatting with him, and I was like, you know what? Let's have him back on. So, Andrew, thank you for coming back on the show today.
Thanks for having me on. Our last conversation was one of those that really fired me up, so I'm excited to get on here again.
You know, I was talking to a sponsor of the podcast the other day, and I was like, I've got the greatest job in the world. I can just call my friends and talk about stocks, and it's just the easiest thing ever. And it's such a blessing to be able to do this. So, yeah, I totally feel where you're coming from, man. Thanks for coming on again.
Yeah, happy to be here. I guess for me, you know, though I do have a podcast myself, I spend a lot more time in the books, so this is my chance to get out of the cave, so to say, and I like doing it every once in a while.
Actually, let's do that real quick. Let's give a proper introduction to your podcast, and hopefully we can send at least one or two people over to listen to your episodes. Tell us where they can find it and what it's called and everything like that. Give us your elevator pitch.
Okay, we're on iTunes. Our big thing is finding your path to financial freedom. So, you know, we don't have as much fun as far as like going into casual topics, but so we get really deep into the nitty-gritty, but we really just try to decode all of the industry jargon and help people get started. And for us, it's big on stocks for the long term. And me personally, I love dividends because to me, half of the equation of compound interest from investing is the income you receive. And so whether you're doing that through lots of capital gains, if that's part of your investment personality, or if you're doing it through something like dividends, whichever it is, you need that incremental compounding in order to build a lot of wealth over the long term.
That makes total sense. So real quick, I don't think you mentioned the name of your podcast. What's it called?
Yeah.
It's a great show. I just search for the
appreciate
show.
It. Investing for Beginners podcast, and then we have a little dash, and then your path to financial freedom.
Got it. Okay, cool. So, you know, you were talking there, and it's something that I picked up on pretty early, and that's the difference between like asset growth to wealth and then streams of income, right? You're talking about balance sheet, you're talking about income statement, right? You've got to have cash flow in order to support you day to day. And that cash flow can help grow the asset base, but you can't have an asset base. Well, you can, but if it doesn't return any cash flow, then I feel that it's not as useful of an asset as if it were one that does both. Kind of like you're talking about dividends, rental properties, things like that. What are your thoughts there?
Yeah, I agree to a point. I think you can achieve, like I said, you can achieve compound interest through various different ways, and capital gains is a good way to do that. And I think if you're in like a retirement account where you can defer taxes, that would be like a win-win. You know, it kind of pops into my mind. Have you heard of the barbell approach?
Oh, yeah. Yep. Let's explain that, though, for the audience.
Okay. So this is something that's gotten a lot more popularity in the past several years. So not to get into the weeds too much, but you have different styles of investing. You can do like a growth investing and value investing. These are like if you're buying stocks for the long term and you're holding them for a very long time, these are kind of the two primary strategies people use. So what they'll do is they'll do half of their portfolio into value, half of their portfolio into growth. So it's like a 50-50 split. So if you imagine a barbell with two weights on either side, you want that to be relatively balanced. The reason for that is you'll have different types of stocks do well in different type of market conditions. So obviously the past decade and almost 2 decades, we've seen huge appreciation in a lot of growth stocks. Just take any of your FANG stocks,
Hmm.
um, Apple, Amazon, you could throw Microsoft in there too. They have all done very, very well. And if you've been somebody who's more primarily value based, you've just been killed. So if you have this barbell approach, then you're more likely to be resistant from those different things when it comes to where the market's going to turn next month, next year, the next 5 years. And so, as it pertains to creating compound interest through capital gains or dividends, when you have growth stocks, those tend to not pay dividends, and value
Hmm.
stocks tend to. Obviously, there's varying shades of gray in between that, but just if we were to take the stereotypes. And so, something that the barbell approach does, and something I think can be useful for the average investor, is if you can position your types of accounts to make basically optimize the strategy the best. So as an example, if you're collecting dividends, um, if you're collecting dividends or if you are basically turning stocks around a lot, like
Hmm.
do always getting capital gains. Both of those things will be taxed a lot. So
Hmm.
you want to put, if you're doing some sort of a balanced portfolio, you would want to put those in a tax deferred retirement account. Whether that's tax deferred or you're getting tax savings up front, doesn't matter. You want to try to shield yourself from some of those taxes by putting those things in those accounts. And then when you have something that's maybe more of a growthy type thing where it doesn't pay a dividend and you're just holding it for 20 years, you probably want to put those type of stocks into a regular brokerage account, but you're not going to pay taxes on it anyways because you're just sitting on it and letting it grow over time.
Hmm.
So that's kind of like an approach where if you have the luxury of having a lot of capital to allocate and kind of looking between using tax deferred accounts, retirement accounts versus non-retirement accounts, that could be a thing to do. And when it comes to compound interest over the long term, any little advantage you can give yourself, I think, can pay off. Not to no pun intended, but it can pay off with dividends over the future.
Hmm.
And it's just because of the way compound interest works. You start with small gains and even small differences in gains. And if you think of like a snowball that becomes really, really big as it rolls down a hill, those small gains turn into huge outcomes at the end because of the way that compound interest works. And it works like an exponential curve if you know the math behind that.
Right.
And it just really just multiplies on itself.
Huh. Talking about that, I don't know so much about the audience. I've never polled them, but it'd be interesting to know. Like for me, I am in and out of stocks, mainly in options. There are times where I will buy the stock outright, but I'm not in them long enough to collect the dividend income. But my goal is to create the income from selling the puts and the put spreads there. Um, and I mean, a ton of people do this strategy, and it's because it works. And for me, that's been where I've gravitated to over the years, right? With something like a put spread, I can do that in Amazon or I can do that in Microsoft. I can do it in a $3,000 Amazon or a $100 Apple, something like that, and get roughly the same return on my investment there, if you want to call it that, because I'm taking the same two, three, $500 in risk per contract, um, depending on any size there. So I think that's interesting, right? We all at the end of the day, traders, investors, and things, we all want to be able to catch a rising wave and ride on the back of that wave as far as it can go. And we can do it by different means. And I love hearing different people's takes on things, because that's one of the reasons I really liked having you on last time, was that you've got a totally different perspective, right? Me looking at something where you said, holding it for 20 years, I couldn't imagine doing that. And that doesn't mean that I'm wrong and you're right, or you're right and I'm wrong kind of deal. It's that we have our different perspectives on how to make this work. And it really is a function of the level, I guess you call it level of skill in that particular arena, right? I would have no chance in competing in your arena until I had developed the skill in order to trade long term like that. And same thing, like somebody walking off the street, they're not going to be able to understand how to effectively be an options trader, because listen, it took me a lot of Wall Street tuition to figure out how to do this correctly. And now that I have done it, I couldn't imagine going back. But it's getting from now until later, it's all about managing that risk, like you're talking about, finding the opportunities, like you're talking about there too. So yeah, I appreciate that. Now you mentioned something about REITs. So tell me more about REITs. And I have just like dabbled into the REIT world. So a REIT is a real estate investment trust, and you can buy into them, or at least I did, just like a stock. And it was brought to my attention by a former colleague of mine, and he's like, you know what? REITs are the way to go. You get paid that income every month, and it's going to be awesome. So tell me more about that, Andrew.
It's a great way to get started with dividends, because the way they are structured, you get more of a dividend than you would a regular company. And the reason for that is because primarily, if you think of the average company, they are going to be buying assets, using those assets to create earnings. So, we take like Apple as an example. They don't really do their manufacturing in-house, but let's pretend like they had factories in the United States, and let's pretend that that's how they made iPhones. You would basically, to grow as Apple, obviously they would spend money on marketing and everything too, but they would need to spend to up their manufacturing, and so they're going to have to invest money into that, and that's kind of, you grow with those investments over time. For real estate, instead of buying an asset that would kind of go down in value, because you build a factory, it would need more maintenance as the time goes on, and the factory would break down. These are just the realities of things in the physical world. And think of like a car, how its value depreciates over time. It's the same with these companies when they reinvest in themselves and buy these type of assets. But when you look at real estate, that's a completely different type of asset, because that tends to appreciate and it tends to go up in value over time. And so the primary way that a company that's structured like a REIT would grow is just to buy a bunch of real estate. And so there's a lot of different uses for these REITs. So you can think of maybe more traditional, like an apartment complex. They buy a bunch of land, develop the apartment buildings, and then collect income from their tenants. You also have like mall REITs. So Simon Properties is an example of that. They'll buy, I don't know if they develop. So REITs, they can develop it themselves, or they can just kind of buy and sell these properties. You have data center REITs. They host these big data centers and lease them out to other companies to use. So the application for REITs is huge, and it was definitely a lot more widespread around the business world than I realized before I dove into REITs. What makes them attractive right now is throughout 2020, they have been really beaten up for a wide variety of macroeconomic conditions. And a huge one, in my opinion, is that I think a lot of people are bearish on real estate, just in general. And you see it with a lot of small businesses going bankrupt and everything. To be sure, commercial real estate it's a tough market right now. The supply and demand, right? When the demand for commercial real estate goes down, whether that's because of less office demand because more people are working from home, whether that's because, again, like restaurants and other small businesses are going out of business, that's going to have a drag on the commercial real estate and make it tough for for landlords to create an income from their tenants and for them to see that value go up because it's not as much in demand. When I look at the opposite side of real estate, when it comes to the residential side, I've been very, very bullish on that all year long. And in my mind, it looks like we're just at the beginning of a huge boom for a variety of reasons. One, personal balance sheets are through the roof. People have been saving like
Mm.
crazy, and you can see that in the macroeconomic data. You can see that from the data from the banks. And we have just really a much healthier customer than we did back when basically 2007, 2008, that the whole housing market crashed really bad. People were over leveraged. They had three mortgages, whatever it was. Um, Nowadays, people are a lot more conservative. The financing is a lot more conservative. They're not extending three or four mortgages to you if you have like a part-time job like they were.
Mm-hmm.
So the lending's more conservative. The home building is a lot more conservative. I have a home builder in my portfolio right now, and they are just struggling. They're like basically turning business down because they just can't build homes fast enough because people are just they're going crazy with the low interest rates, and you combine that with the fact that people's balance sheets are very, very strong, much stronger than they were 10 years ago. Their incomes are a lot higher than they were 10 years ago. And you have the millennials, which are coming of home buying age, and you just have all of these huge factors that are creating a boom. And so it's a weird dichotomy where you have residential real estate going through the roof. Commercial real estate is really stagnant. And so I guess it's tough to look at REITs because it reminds me of like San Francisco. I don't know if you've ever been there.
Mm-hmm. Yeah, I
Uh,
went last year actually. Yeah,
okay. Not
before the
no, you know,
virus. Yeah.
right, exactly. uh, no hate for anybody who's from there. I'm a SoCal boy myself, so I have some California roots. But it's depending on which street you walk in downtown, uh, it's a very different environment. And I feel that REITs are very similar in that way too. And so you have to be careful with REITs, but they have all of these inherent advantages. And part of that has to do with the fact that they buy real estate. And so bringing it all full circle back to the dividends. Um, a regular company can choose whether they want to pay a dividend or not. With REITs, because they are structured and regulated to particularly buy pieces of real estate, they are by law required to pay out a certain amount of dividends every year, and as part of it's like a percentage of their total earnings.
Hmm.
And so it makes for more guaranteed income than you would a regular stock. Of course, there's downsides to it. They have to add a lot more debt than the regular company um, because they can't grow from their cash flows like a company like Apple could because they have to pay out a lot of it in dividends. So they're very leveraged, but you find good managed REITs that are doing it in the right way and making sure they don't overextend. And it can have a lot of benefits for people who are looking for income. And if you think about the fact that some of the best performers have been REITs, American Tower AMT, that was one of those stocks that went up like 100x because they were part of the cellular towers and they were all beaten up decades ago. And then obviously with everybody pushing the 5G, the skyrocket popularity of smartphones, you've seen just a lot of prosperity there. So you can have a lot of compounding, not just from the dividends themselves, but from these REITs as they grow as businesses. But it just has a lot of things that are very attractive for people who are looking to compound over time.
Hmm. That's really interesting. I may have to revisit that in my own portfolio. Like I said, it's not been on my radar, and certainly not an investing style that I've adopted. But I kind of like it. I like the idea of where it's coming from there.
I think they're like I said, it's a very opportune time to be looking into them because they're so beaten up. And so,
Mm.
if you can, for me, when I try to buy these stocks long term, I'm trying to roughly determine how much they are worth based on how much they're going to grow in the future.
Hmm.
And so, you'll have obviously, it's very hard to beat somebody like Google or Apple or Microsoft and these guys. especially, Microsoft, Google, and Amazon, these guys growing double digits for who knows how long, and they just keep
Mhm.
doing it. It's astounding. But if you pay too much of a price in relation to how high they are growing, you're still going to have trouble getting returns over the long run, because when expectations are so high, then it's almost like it's expected that they're going to continue to grow double digits, and in the one kind of chance that they stumble, then you're going to see the share price kind of take a dip. And so
Mhm.
for me, I like to be conservative, and if I'm going to buy something that's growing, I want it to grow, but I don't want to pay too much in relation to how much it's growing. And that way, if they stumble, like all businesses tend to do, they're not going to have as much of a dip. And if anything, they might see their stock price increase, because relative to the expectations, they still did really well.
Yeah. I could see a lot of concern though, because I've been super bearish on corporate real estate for a long time. I mean, I personally know several companies that have gone all remote, and they said this is it. This is the new way of life, and I think it's great personally. Um, but the flip side of that is we created this culture over you know I don't know how long would blue collar or white collar jobs be around, last 120 years, I guess you could say, from 1900 or so. This culture of getting in a car, driving a rush hour, or getting on your metro or whatever it is, going to the office building, being miserable there all day, getting your lunch somewhere across the street, working the rest of the day, driving home in your car in rush hour again, and just repeat. And now I mean, I personally, I'm benefiting from this a ton. Spending more time with my family, spending less on gas and tolls and all this stuff. And I mean, I could drive. I live in Dallas, and I can drive in rush hour and get to anywhere I want, like on time now, and that never existed before. So I really think that long term, I think that there's going to be some significant hurdles to overcome. And on the REIT front, I don't know how much the stock price correlates to like the asset price, but I think what we're going to see personally, my opinion, obviously, is a collapse in the corporate real estate market, the commercial real estate market, I should say, because everybody's buying everything from home. You've got all these buildings that went up with like a WeWork fashion, that they don't need that anymore. Everything that they had provided for the WeWork crowd, they now do from home. And so I think that there is going to be some significant pain. However, once that pain's over, this could be a great opportunity. This could be like the buy of the century. Once people figure out what the new normal will be. What are your thoughts on that?
I'm glad you brought it up, and it's a great insight, because it kind of goes back to that dichotomy of the two different streets in the same city. So, as an example of a REIT, where I think something, like as an investment opportunity, a good REIT would be maybe something that's anchored. So they have these things called anchor tenants, and these are the tenants, if they have like a big plaza with a bunch of people and shops and everything, where people go.
Hmm.
These tenants are the ones that drive the most traffic,
Like
and
a
so
Walmart in a
yeah,
certain area.
yeah.
Yeah.
So yeah, I'm thinking of like particularly like grocery stores. So if you think of, in my neck of the woods, we have this grocery store called Harris Teeter, but you can substitute like a Whole Foods,
Hmm.
or back in California we had Sprouts, and I think Sprouts is coming to the East Coast too. So these, Trader Joe's, another one. These like very popular grocery stores as anchor tenants. Those REITs have been collecting almost all of their rents, because it's like these places where people can't necessarily, um, they can't outsource this as much. Like, yeah, you can get groceries delivered from home, but a lot of people still like to go in their car, because you want to pick out your produce and things
Hmm.
like that's a little more intimate when it comes to grocery shopping. Whereas you take the flip side of that, and a lot less people are going to the malls to get
Right.
something that they needed to buy for Christmas or whatever it was. And so when you look at the financial statements for mall REITs, going back to like a Simon Property, they've struggled a lot more on the rent collection front. And so there's really like all sorts of types of REITs, and um, yeah, I can see one section of the market kind of falling out, and another section just really showing how certain types of essential businesses and the real estate that they occupy are just becoming more and more valuable,
Hmm.
where others are not. So I'll give one more example of this.
Sure. And I
One
was
of
just
the
gonna to interject there. I mean, that
Yeah,
should be reflective in the stock price, right? I mean, if it's
you
in
would
a sector
think
that's doing well, it should be going up.
that it's what's interesting about REITs right now as we record this January 2021. All REITs are getting this blanket kind of treatment on Wall Street right now, where you do have some differences in some of the more high quality names. They're not beaten down as much, but as a group in general, they are still beaten down quite a bit compared to some of the other stocks that you've seen that have rebounded and then some.
Mm.
So whether that's because of certain ETF themes, whether it's because institutions are slower to pick up on the differences, whatever it is, retail investor, whatever. This is just what I'm seeing and what I'm observing. So to kind of tag on to that one more idea here, something that Amazon definitely changed in the way we do business is this whole idea of direct to consumer, getting your thing in within 2 days or less with
Hmm.
Amazon Prime. And they completely revolutionized the retail business, because in the past, if you had someone like a Walmart, they would have to build up all these stores. They would have to build up inventory in each of these stores. It's very costly and very expensive, and it takes a long time to build. Amazon just kind of took that away, and basically, instead of having all these stores everywhere, they just had sectioned distribution centers. I apologize, my phone's like out of reach at the moment,
No, it's all
but
good.
if it's ringing and being annoying. So they have these distribution centers, and they don't need hardly as many distribution centers as Walmart would need like stores. And so you have these type of REITs that are distribution centers, and those are going through the roof as far as demand on Wall Street, because people are recognizing that all the shift is to e-commerce and to getting things shipped directly to people's doors. And so
Hmm.
where the old way of seeing a piece of real estate as attractive was maybe being close to a lot of homes and being part of a big shopping center, now it's a little bit smaller, and it just, if it's close to all these methods of transport for logistics, that becomes a lot more valuable. And so it's a very interesting space, and I think we'll see. I mean, you could argue we'll see it with all sorts of businesses, but in REITs as well, I think you'll see huge discrepancies in results based on the shifts in consumer behavior, which have always kind of been happening, but obviously they've been accelerated in the last 12 months due to everything that's been going on. And so it's going to be interesting to as it plays out. And so I think investors need to be careful, and that's why we try to teach on our show is the importance of knowing what you're doing and trying not to make blanket decisions on everything. Like, not to say that yes, I'm all in for REITs, or no, I'm not, but to try to understand what the business does and what's going to drive its success moving forward.
Hmm.
And I think that's the way that if you're going to try to pick winners and losers, that's got to be the way to do it for the long term.
That makes sense. Is there a resource that you know of where someone could go and see like a list of REITs or something that you're interested in or looking at?
Yeah, that's a good question. I use a free website called Finviz. It's finviz.com.
Hmm.
And so you can click through their different sectors and industries. And so within sectors, there's just the 11 sectors, I believe. And so real estate's one of those. But you can basically filter through each of these different categorizations, and you can go down, and they have lists of the different types of REITs. So whether it's like an office REIT
Oh, cool, cool.
or like a healthcare REIT, and you can just click into those, and they'll give you a list of the tickers, and then you can kind of sort and mix to your heart's desire on there.
Listen, that's exactly the resource that I was thinking of while you were talking. Like, okay, I need a list of REITs first off, and then I need to be able to differentiate if they're commercial REITs or if they're residential REITs and things of that nature.
Yep.
So cool. Yeah, I'll have to go check that out. And I would encourage everyone listening to do that as well. Finviz.com. I've looked at it before. It's not on my radar for anything right now, but it certainly will be as soon as we get done.
Yeah, cool. It's cool to see everything like all in the list.
You know, we have things so good. I mean,
Yeah.
really, you step back and think about like our grandparents or our parents or things trying to do what we do now. It wouldn't be possible. I mean, like I remember my dad trying to trade stocks when I was a kid, and I remember him telling me that it was $50 to open a trade and $50 to close at the local like walk-in JP Morgan. Or was it JP Morgan? No, Edward Jones. And like just the ease of access that we have now. Like if you had told somebody 50 years ago, 20 years, 15 years ago, hey, I'm interested in REITs, let me get some more information on that. I don't even know if these resources would have been available if you couldn't have been an informed investor enough at that point. Man, we got it so good these days. And it's only going to get better. Kids these days have no idea what we had to go through.
And just think about the opportunity that brings, right? Because
Yes.
in the past, you really did have to be a professional and just to have access to all these sorts of things.
Mm-hmm.
Now anybody can look up all of these resources for free. And so I think it provides an opportunity like we've never seen before for a new type of lifestyle almost. Why can't investing be a lifestyle? Why if we're going to Home Depot to DIY our house and maybe, back in the day people used to DIY their cars, it doesn't seem like that's a popular thing anymore. Why not DIY the investing? And I think it's cool that you have a show like yours. We're trying to help people do exactly that. And whether that's your brand of DIY investing or my brand of DIY investing, right. I think people are in the right place to try to learn as much as they can and just really stay curious and try to figure out how things work before you make up your mind on how you think things work.
Mm-hmm. Yeah. And I appreciate the fact that I'm able to chat with people like you and get others' opinions. I love that about the show because like never ever have I called up somebody and been like, hey, come on the show, let's have a chat, and either one of us say my way is right, your way is wrong, you're stupid. That's never happened. And I think it's because we as investors and traders are mature enough to understand that everyone has their own style and whatever works for them. And God forbid me try and do your style just out the gate and vice versa. It's going to be in for a world of hurt. I remember I had one guest on one time and his style is buying out of the money calls and just buying like boatloads of them and catching those, minute moves that he could get, but in volume. And there's no possible way that my stomach ulcers could handle that kind of trading. But it works for him. And I think that that's great. Now, there have been 2 times where I've had people on where, like, I could just tell, and I'll never tell who it was. But it maybe a loyal viewer could figure it out. But, like, they were just straight up fake gurus. Like, I mean, this guy went on for an hour in, like, motivational speech mode. And at the end of it, I'm like, I feel like you gave us nothing, and I don't think you actually know what you're talking about. And that's the difference between somebody who actually trades or invests and people who don't, is because we can see right through that kind of stuff, right? There's all these TikTok gurus now. Like there's a viral video right now of it's a couple, and they're like, oh, we made $20,000 this month. Here's our strategy. When the stock's going up, we buy it. When the stock's going down, we get out of it. I kid you not,
saw
Andrew.
that one.
Yeah,
I saw it.
It's a thing.
While
that is
scary,
exciting,
right?
it does empower people like you were just talking about. I also think that will wreck people like no one's business. I can't tell you how many times I've seen, thankfully, with the internet, when people do well, they like to share that. But they also don't like to talk about when they don't do well. It's like they disappear. But I've heard all these stories where like in particular, it was last year, when everybody was in lockdown. They just got their stimulus checks and things. This person who started buying out of the money calls did really well because the market was going basically straight up at that point. And he kept going. I mean, he took just a few $1,000s and made $900,000 out of it. He did great. He took out mortgages on his house, and he's like, I am such a genius. And within like a month, it was gone. Still owed the mortgage and everything. And he was trying to blame Robinhood. Like it was Robinhood's fault that he lost the money. Even though it wasn't Robinhood's fault when he won the money, it's Robinhood's fault when he lost the money. And that's where I'm also concerned. Is I'm excited for this new generation of traders and investors and the access and the ease and the ability to get in and out of everything we want to at the click of a button. But there are significant ramifications of that, and that's what I like to call my Wall Street tuition. I paid that, Andrew. I blew up my account twice before I figured things out. And to tell you, to this day, I still probably haven't figured out everything. But I figured out what works for me. And so, with all these new people in the market, I would really just caution you to understand your risk. Just understand what you're getting into, why you're getting into it, and when you're going to get out. Because it's all great when things are working, but it's when it turns against you and you don't have a plan and you don't know what to do and you're scared of losing money that things just go awry. The emotions involved in trading and investing can lead to really poor decisions if you let it. I mean, it's not as easy as, hey, I'll buy a stock when it's going up and hey, I'll sell it when it's going down.
It really isn't. And maybe you can provide a good example of how you apply it to your strategy. So for me, I really, really need a laser focus on why this company is good, what their competitive advantage is, and why that's going to lead them to long-term success. Because inevitably, I'm going to have stocks that drop in value. And so, I could be doing this research on these stocks and they could go up and I see money go up on my account, and that's all good and fine. It's easy. It wasn't too hard to get on and ride that wave, as you like to say, right? But where your mettle as an investor is tested is when the stock, which that business is good, that they're going to be good over the long term, what their competitive advantages are. But when the market doesn't agree with you temporarily, if you haven't done the research to understand those reasons why you're buying it, then when the market panics, you're going to panic as well, and you're going to sell out of the stock. And that's exactly how you can't invest. And so, to your point, like not every stock you buy is going to go up. Not every position you open is going to end up profitable. So you have to think about what's the potential downside, what are the risks. And so that's where the knowledge and the application, the studying can really take you further, because it's in those stocks that you hold your conviction and you add more when everybody else is running to the exits. And then when everything recovers after that, and you have the stocks that you've done that with, that's where you'll see outsized returns. And that's what I try to narrow down. I know it's not fun to talk about sometimes, and nobody wants to have to do homework and really laser down on some of these things that are hard to do, but you got to.
And it's so interesting, and I love talking to other people, because like that is like the opposite of the way I trade, and that's okay because it works for me and it works for you. But for me, I will give you a nutshell. So I have a training course where I go through literally everything top to bottom. But in a nutshell, the way that I trade is I find a stock that I like. I do back testing on the moving averages. So if it's the 20-day, 15-day, 10-day, that's generally what I go on. And I find the one that has the highest historical return. And I say, okay, that's my starting point. If, let's say, if Apple's over the 10-day, I'm interested in Apple. So then I'm watching it. And then I also have an artificial intelligence data provider that I work with called finclub.ai. And basically, there are days when they give red lights and green lights. So I'm watching Apple like a hawk. Once I get my green light, I'm in. And then what's really cool is about the way that I trade is there's always a gap. There's always a gap between the stock price today and that moving average. And maybe it's $2, $3, maybe it's $20, something like that. And I'll sell put spreads along that back test moving average. And basically, as long as it doesn't break through that moving average, it can come down, it can touch it, and it can bounce back up, things like that. But historically, my research has shown that if I follow this backtested moving average, selling the put spreads on it, I can literally ride this into the sunset until it comes back down. And so that's the way that I trade in a nutshell. And I mean, it's so simple that when I was doing the course, like I can trade my entire portfolio within a 10-minute frame. And I set a timer inside the course, and I was like, here's 10 minutes, watch. Boom, 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 done. And I can go all the way invested all the way to cash in a single day if things happen like that. So, I mean, it's a very, very different style of trading to you, but it works for me. And I'm also not day trading. I only do it twice a day. I couldn't imagine sitting there day trading like that. But because of that you could call it margin of error between the stock price and where that back test moving average is, there are days when you have to do a single thing. Just let it work.
And you mentioned that the tuition that you had to earn by learning these things the hard way and learning what parts of the strategy are kind of more effective and more likely to work versus what you thought was, oh, well, if I just look at this, then that's what I need to do. But as you learn and you start to gain experience, you learn what your biases were and what works and what doesn't for you. And you only do that from being self-reflective. You could look at a nail and think every nail needs a hammer. You could look at every idea that you try to take and think that just because it's not working for you now, there needs to be self-reflection, and I think that takes some thought to do. And
what I'll do is probably once a quarter, I'll go back to all the trades that I lost on. I did this at the end of the year, and just look at it on a chart, see the day I went in, see the day I got out, see what happened, and be like, follow the plan. Sometimes losers happen, but every once in a while I'll make a mistake. And then, it's like, add that to the list of things I'm not going to do in the future.
Yeah.
So
you had that when you were starting, I'm sure, where you thought your system should work a certain way. And it took the research to realize I need to go a different path.
Oh my gosh, Andrew, let me tell you, when I blew out my account, 2/3 of my account in the first 60 days of opening it, I figured that I may not be knowing what I was doing, even though I thought I did.
All right, exactly.
So Andrew, hey, listen, man, we covered a lot of topics today. We want to make sure we had people or send people over to FinViz to learn more about the REIT space you were talking about, but also to e-investing for beginners. That's Andrew's website there at Schaefer's Investment Research. And also, after you're finished with this episode, click on over to Andrew's podcast, E-Investing for Beginners podcast. And you said there's a second tagline to that. What was it?
We are the Investing for Beginners podcast, your path to financial freedom.
That's right.
And if you go on our website, it's a great resource for learning about REITs too. You can just go in the search bar and you can type in REIT. I've done one of my business partners, Dave Ahern, he's done super extensive guides on how to look at these companies, because again, they're different type of companies, so you have to look at them differently. And hopefully if you use that and you use a website like FinViz to find your ideas, somewhere in there you can find some really profitable opportunities.
Let's hope so. Well, Andrew, listen, I really appreciate your time today. I always think it's funny when I have an episode where I'm talking to myself basically on the screen. It's like I'm talking to the voice of God. I think you've brought some wisdom with us today. So I appreciate that. A little bit of divinity dropping in on us today.
You look good doing it.
Well, I'm going to have my editor make sure it's not just me staring at the camera every time you talk. So it should be okay. I tell you, early on when I was doing my own editing, I would do that. Like it would be me just staring at the screen while the other person talked.
That's funny.
And I'm like, maybe I should do something about that. So yeah, we'll make it look good for you, Andrew. I appreciate your time. I appreciate all the advice and information that you've given us today, and just appreciate being able to chat with you again.
Yeah, it was a lot of fun. Thanks again.
Cool. Yeah. And hey guys, make sure you head on over to einvestingforbeginners.com, Andrew's website, and check out his podcast, E-Investing for Beginners podcast. And thank you so much for tuning in to today's How to Trade Stocks and Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode.
Okay, so what'd you think? That was pretty incredible, right? Now, if you liked that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning and how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.